obviously in, residential real estate, commercial real estate matters, right? Where people want to live, the retail surrounding the residential neighborhoods, where they're working. So I think we'll be able to draw parallels not only across different markets and different countries, but across different types of real estate. So I'm going to frame the conversation using the pandemic. We're sitting here unmasked, shoulder to shoulder, which feels really good, but the pandemic remains a significant factor. It was a notable disruptor affecting all aspects of our lives. And even as the health situation stabilizes, associated impacts of the pandemic are going to prove sticky. In real estate, the trends that gained prominence amid the pandemic were for the most part not new. They weren't new trends. But the pandemic significantly shaped these trends. In some cases, they strengthened and accelerated. In other cases, the trends slowed and even reversed. But the pandemic was directly or indirectly related to all of these changes. So I'm going to start with the sector that not only faced a significant disruption initially, but faces the greatest long-term impacts related to the pandemic. Work from home or remote work is nothing new, but with the pandemic, firms were forced to adopt it wholesale and immediately. And that rapid expansion of fully remote models upended the historical relationship between job growth and demand for space. Office-using employment in many cases held up well. The tenants, as you can see, wasted no time shedding space. So negative net absorption, the yellow bars that you see there, went sharply negative, and vacancy rose sharply higher. And the impacts were far worse in certain markets. The largest, densest, and least affordable office markets faced an outsized impact. Exposure to tech was another key factor that impacted both direct and indirect availabilities. Tech companies were at the forefront in terms of adopting these fully remote models. Now, demand finally returned to positive territory in the second half of last year, and vacancy stabilized. Now, many tenants chose to shed space ahead of lease expirations, and that caused sublease availability to surge. Again, those impacts were not shared equally across markets. Exposure to tech, density, caused availability to move sharply higher in markets like San Francisco and New York City. Over the past year or so, sublease availability has stabilized, but it remains really high. 200 million square feet, 2% of inventory, and until we see more notable declines in sublease availability, the broader office market will not recover. Office leasing activity is gradually moving toward normal, and this is perhaps the best indication that the office market is healing. We're still sitting below pre-pandemic norms, but well above 2020 levels. Another good indicator is the trend in average lease sizes. Pre-pandemic, for 15 years or so, the average lease size was consistent, right around 4,000 square feet. The pandemic changed this. Many tenants avoided committing to new space if they could. And if they signed a lease, they often downsized, and the average lease size dropped to 3,000 square feet. Now we're moving back up. The 12-month trailing average is right around 3,600 square feet, so another good sign. Now going forward, we are calling for stabilization in fundamentals, but you can see that vacancy isn't going to see much of a recovery. And that's due in part to the pipeline. So the pipeline is shrinking. So pre-pandemic pre-pandemic, we were sitting at about 160 million square feet underway. Now we're at about 140 million square feet, and starts have moderated even more. The pandemic has made it far more difficult to get financing for spec construction. Still, we have 140 million square feet underway, and 35% is spec, so it remains available. And if you look at the space delivered since the beginning of 2020, 25% is still available for lease. And the outlook for demand is far from certain. I don't know how many of you are aware that every time you swipe your card to enter your office, somebody is tracking that information. And Castle Systems has a great back-to-work barometer across 10 major markets tracking office occupancy. It's now sitting close to the highest level since the beginning of the pandemic, and it's only 40%. So still far from normal. And now there are more and more companies announcing a return to office as opposed to pushing back return to office. But most of these companies are promoting flexibility and hybrid workplace models, and that's going to stay. The market for labor is extremely tight, and most employees want some degree of flexibility. And at this point, we don't know how those hybrid models will impact demand for space. Maybe in a year we'll have a better idea, but at this point, especially across the market, we're just not sure. So a lot of uncertainty. Retail, another sector that faced a significant disruption, particularly in the initial months of the pandemic when we had the lockdown. And this led to a surge in store closures, almost entirely among retailers that were already distressed. They were already underperforming. So the pandemic led to an acceleration, an accelerated shakedown of this retail sector. And once that happened, once we were left with mostly healthy retailers, and retail sales rebounded quickly once the lockdown ended, the retail sector stabilized, and then, as you can see, started to improve pretty notably. This chart captures the trends in the retail sector better than any others. As you can see, the distress was there pre-pandemic. So bankruptcies and store closures started to ramp up in 2019. But in 2020, the pandemic and the measures taken to contain the virus proved to be too much for many retailers. Store closures, bankruptcies, and associated store closures surged in 2020. But again, we got rid of the low-hanging fruit. The retailers left, were healthy, and retail sales moved higher. And you can see in 2021, hardly any bankruptcies, very few store closures, and year to date, we haven't seen any. The impact on leasing in the retail market was notable, but it was short-lived. And by early 2021, we were back to pre-crisis levels. And that's despite a steady decline in average lease sizes as retailers adopt smaller and more efficient footprints. Activity continues to be driven by discounters. So Dollar Tree, Dollar General, Big Lots based in my state, Ohio. Big Lots, Ross stores, so off-price apparel as well. Ross stores, Burlington. We are seeing a lot of activity among fitness centers. So Crunch Fitness, Planet Fitness, and home stores. We all care more about our homes. You all know better than most. Going forward, the limited development pipeline contributes to further tightening in the retail sector. There's only 52 million square feet of space underway right now. It's a 10-year low, and 75% is pre-leased. Most of it is single tenant, freestanding, retail. Now, the strengthening in the overall market masks significant bifurcation below the surface. So the gap between the best performing assets and the weakest assets, that's likely to grow. Retailers are focusing their expansion plans on the fast-growing metros in the South and the West. They're largely avoiding slow-growth Midwest and Northeast metros. And then within metros, retailers continue to shutter locations in secondary and tertiary locations. That shrinking store footprint as well is contributing to obsolescence. Nothing new, but it's continuing. So if you're a large box in a less desirable retail corridor, you're gonna have trouble finding tenants. But overall, good news for the retail sector. I'm now gonna cover two sectors that actually benefited from the pandemic. First, the apartment sector. Now, many of the factors supporting demand for apartments were there pre-crisis. We were living more transiently, we were settling down later, waiting longer to have kids. Over the last several decades, there has been a significant shift in the dominant household type. It's no longer married with kids, it's now singles and married without kids. And singles have the highest propensity to rent. 50% of singles rent apartments. Now, the pandemic led some other trends to emerge. Early on, through lockdown and the period of social distancing, we amassed excess savings. So financially, we were looking better and better. So after living with roommates or family, households not only had the means, but they probably had the motivation to form new households, live on their own. And some of these households purchased homes, but most of them rented apartments. There was also pent-up demand generated by the lockdown. Recent college grads are a good example. If you graduate in the first few months of the pandemic, the job market is unstable, the health situation is highly unstable, so you move home with mom and dad. And then when the job market improves again and the health situation is looking a little better, that pent-up demand is released. And you can see the surge in demand last year, so a lot of pent-up demand. Remote work is also supporting demand for apartments. You don't want to be tied down by a mortgage. You want that flexibility that an apartment will give you. The limited supply of single-family housing is another big factor. You all know that inventory is quite low in single-family housing. We have been underbuilding since the great financial crisis. And with low interest rates and excess savings fueling demand, it didn't take long for demand to significantly outpace supply in single-family housing. And that caused prices to shoot up, and that in turn led more and more households to be priced out of homeownership. And that keeps them in the renter pool. Demand is now moderating. So what we saw last year was simply not sustainable. Pent-up demand has largely been satisfied, and with availability so low, limited pool of available units, that will weigh on absorption as well. Still many factors supporting demand: the limited supply of single-family housing, strong wage growth, the mobile workforce, that will all support demand for apartments, but it's going to look a little more moderate. And there is still a lot of supply underway. The pipeline is sitting at 700,000 apartment units. Starts are declining pretty significantly, but the pipeline is shrinking slowly. And that's because developers are really having trouble delivering units. They can't find the appliances they need, they can't get other materials, so that's slowing the pace of deliveries. And that will help the market maintain a little more balance than it would have otherwise. And there are always upside and downside risks. And this is a great leading indicator of apartment demand: search activity. So before you commit to a new apartment, you look at your options online. This is a view of search activity from apartments.com. And the red line is what we're seeing currently. And it remains well above prior year levels, actually in line with 2020, which we know was a record year for demand. So there's upside risk for demand, and supply could slow even further due to those development delays. This is perhaps one of the more notable trends to emerge during the pandemic, especially initially. It reversed a multi-year trend of urbanization. Households left urban areas in droves, preferring space, affordability, and social distance of the suburbs. And working from home kind of sealed the deal. Why would you pay a location premium if offices are closed, amenities are offline? And rents reflect this flight out of urban areas. So rents in urban properties declined through 2020. And then toward the end of that year, renters were lured back by lower rents, healthy concessions packages, and the pace of the return picked up speed as the health situation improved. Offices opened, stadiums once again hosted events, and rents started to trend higher. In recent quarters, urban rents, the blue line, have stabilized, and that reflects a couple of different factors. We had a couple surges of COVID, first Delta, then Omicron. All these companies pushed back their return to office plans with those surges, and development activity, for the most part, is concentrated in downtown markets. So you're competing for renters with a large number of new units. Finally, the industrial sector. Fundamentals look a lot like the apartment sector. Surging demand, far outpacing new supply, and a sharp decline in vacancy. And the answer, the explanation, is relatively simple. Strong household balance sheets and pent-up demand fueled a surge in goods consumption. And most of the goods that we purchase are imported. So I'm sure you saw pictures of all the backlogs at our ports. Did I do that? Or is that Carmen telling me to hurry up? I mean, we can serve the champagne in here, right?
Yeah. Maybe we should have that.
So the goods come into the ports, right? And then they need to be transported across the country, sorted and stored in logistics facilities along the way before they reach the consumer. E-commerce also plays a role, particularly just-in-time delivery expectations. More trucks, more drivers, more modern distribution space, and reverse logistics. When we buy something online, we're far more likely to return it. Reverse logistics is the handling of those massive volumes of returns. That requires a lot more space than forward logistics. So all of those factors combined to drive leasing to record levels last year. 20% higher than the prior record in 2020. And leasing last year accelerated in all markets, but most notably in small spillover markets. Because, okay, Carmen, I didn't do that. We have run out of developable land in many of the major industrial markets, the markets that are closest to the big population centers. And so leasing accelerated most in these small markets like Lehigh Valley, Scranton, Reading. They all support the I-95 corridor, the Mid-Atlantic. Markets like Spartanburg, supporting the I-85, which is Charlotte to Atlanta. Las Vegas, the goods come in at the ports of LA. Las Vegas is a great spot to sort, distribute, drive them across the country. If you look at the quarterly trends, you can see that leasing might have peaked in the second quarter of last year. Peaked at a high, it's stabilizing at a high level, but it does appear to be slowing. The pipeline is not slowing, however. The pipeline continues to expand. Now 550 million square feet of space is underway, and 60% is spec. So even as demand remains solid, it's likely to fall short of supply. Now, as in the other sectors, there are upside and downside risks. Inflation is an important downside risk for the industrial sector, to the extent that it impacts spending on goods leasing. That's a longer term risk. It'll take some time for that to move its way through the system. But there's also a significant probability that the supply chain issues, the labor and material shortages will contribute to continuing development delays, and that'll slow the pace of new supply. I know you have another panel, so I'm going to be really quick with this, but money's money. Yeah, money's money. And there is no shortage of it chasing commercial real estate. So in 2021, more than $900 billion in commercial real estate assets traded. That's almost double the 2020 total, driven by multifamily and industrial. Combined, those two sectors represent about 60% of last year's total. And it was a record year across these four major property sectors, even the office sector with its ongoing challenges. And a fourth quarter burst of activity contributed to those gains across sectors, but particularly in multifamily. Now, for the most part, it's the sales of more secure, income-producing assets that are driving activity and pricing, which I'll show in another slide. So in the office sector, that means well-leased trophy assets. That's where the demand is concentrated. In retail, it's the single-tenant net lease sector. In industrial, it's modern distribution centers that have long-term leases in place. In apartments, it's pretty much everything. Strong demand across the multifamily sector. And pricing has increased rapidly, particularly in multifamily and industrial. So last year, each were up about 10%. Retail and office prices were up a more modest 3%. I'm fairly confident in the forecasts you see here, with the exception of office. If you're going to see distress, that's another factor that has supported the pricing you see here. We haven't seen much distress at all. But if we're going to see it, it will likely be in the office sector. And to the extent that work from home impacts office occupancy over the longer term, that would also have significant implications for values. And finally, cap rates. Cap rates have continued to move lower, particularly in multifamily and industrial. And it's the weight of capital that is driving cap rates lower. It's, you've got to pay to play. If you want to invest in the space, you have to pay the price. Going forward, we're not overly concerned about Fed tightening. And that's because there's still a decent cushion between cap rates and treasury or bond rates. Also, we're anticipating continued strong rent growth, which will fuel income growth, which will keep cap rates stable. And cap rates are really not correlated to treasury or bond rates. They're far more correlated to performance variables. And lastly, that weight of capital is not going to ease. There is all kinds of dry powder waiting to invest in real estate. And the economic backdrop, we heard about it earlier, we're calling for steady economic growth. And inflation is actually good for commercial real estate because it's a hedge. It's a hedge against inflation. Commercial real estate cash flow adjusts, moves higher with inflation, and that gives it a distinct advantage over fixed income. And that's it. I'm thirsty.